Okay, so welcome again. In this case, this is the last presentation, the last but not the least, and we have the honor of having here on Tobias Carlisle. Tobias is a friend. We had him last year in Madrid in our annual event, but in that case was a presential one, so it was face-to-face. And this year, due to the circumstances, so we have done this online event, and he's one out of 12 speakers. As you know, he's an expert in value investing, in deep value, especially, and he runs his fund that is called ZIG, the Aquarius Fund. The ticker is ZIG, and for me, it's really. I'm super glad of having him here because he empowers investors through teachings, education. He has written a couple of books that are awesome. 3 books, actually, I think, because he wrote with Wes Gray another one. And in his case, you can learn a lot about the basis and the understanding of value investing. And this is quite interesting, especially in a situation that we are getting through now, where value investing is underperforming a lot. So I hope he helps us to understand what the heck is going on. So, Toby, thank you. It's a pleasure to have you on.
Gracias, Ivan. Thanks so much. I really do appreciate the very kind introduction. It's great seeing you again. I wish it was back in Madrid like it was last year. That was really fun. But how do I share my screen with you?
Sure, let's go.
Just
go ahead with the presentation. Awesome.
Okay. Okay. Do you have the screen now? Do you have that shared?
Yes, we can see it. Yeah, that's it.
The subject of my talk today is the acquirer's multiple, which is a metric that large financial acquirers use when they are thinking about investing in companies. So when I talk about a financial acquirer, I mean a private equity firm that might want to take a company private, or an activist firm that might want to interact with the management of a listed company and have them change their capital structure, change the way they run their business, change the way that they are governed. And I want to explain all of that so that you can understand what deep value is and how that's different from perhaps the way that other folks have practiced value. The title of the speech is also the title of a book that I have written called The Acquirer's Multiple, which discusses how some of these bigger investors think about the way that they invest, what they're looking for, and how that has tended to work on a quantitative basis in the data that we have. And it starts variously at different stages, but I'll show you some of that data today to explain what this method of investment has achieved in the past and why it's underperforming right now. I've written some other books, Deep Value, which came out in 2014, which is sort of a more academic version of the acquirer's multiple. Concentrated Investing, which came out in 2016, which looked at some investors who had very long track records, 25-year track records, value guys who had outperformed over that period of time and who had very concentrated portfolios. So we go through the methods of concentration and diversification that worked for them. Quantitative Value, which I wrote with Wes, which I understand Wes has spoken. Again, we just took every bit of industry and academic research that we could find and tested it to see what had worked and what hasn't worked. I've also contributed to the Journal of Applied Corporate Finance, various introductory textbooks on corporate finance and other books on special situation investing and just rules-based investing. I've delivered some variation of this speech at ZONAVALVE last year in Madrid, which was really fun, at the Los Angeles CFA Society, the New York Society of Security Analysts, Harvard, Bloomberg, Caltech, and so on. The original formulation of value investing is given by John Burr Williams in a book called The Theory of Investment Value. It's very simply the discounted cash flow analysis. So you'll see that he just talks about cash inflows and outflows discounted at the appropriate rate for the remaining life of the asset. It's very, very easy to say. It's quite hard to do in practice because there are all of these tiny little changes that you can make that will give you a very wide range of outcomes. And often the difficulty when making an assessment of value is determining the appropriate discount rate, how slowly the company will continue to grow, or if it'll in fact start shrinking, and what that does to the value over time. Determining the valuation is one thing. The idea of value investing, though, is to try and buy it at a big discount to that valuation. And that's what Benjamin Graham, who's the father of value investing, he codified value in a book called Security Analysis. He calls that the margin of safety, where you try to buy at a big discount to what the company or the business is worth. And then over time, the price drifts back to the underlying value, drifts up to the underlying value. And that process is called mean reversion. Graham appeared before a Senate committee in 1955, and the Senate committee chair asked him, how is it that the price gets back to the value? What's the process? And Graham gave one of those great answers where he said, it's a mystery. It's a mystery to everybody, but all we know is that over time it slowly gets there. He was being a little bit coy because the answer is sort of a microeconomic answer where fundamental investors, value investors, private equity firms will see something that allows them to earn a slightly higher return than other assets that are available, and they will bid up that asset. They'll bid up the share price until that arbitrage opportunity is gone, and that's how these returns are generated. And then, of course, the underlying business should generate returns over time. So that's basically the process. I always put this little woodcut, which is an Albrecht Dürer woodcut up, and it's a wheel of fortune with that's Fortuna, the goddess Fortuna's hand puppeting the wheel of fortune, making it go round and round, and the sort of half donkey, half man creatures that are clinging to it are something like investors in the stock market, where when they're at the very pinnacle of a stock's run, when mean reversion is most likely to pull a stock down, they imagine that they keep on ascending up, and here he is reaching for the sun when most likely he's about to descend down the other side. And there's a fourth figure that's not on the wheel of fortune there because he's fallen off the bottom. And that's probably the best time to buy a stock, when it looks worst for it. And that's sort of what I try to do. We can show the performance of value or the utility of value many, many different ways. This is one way of doing it. We take the French, Ken French has a website where he has tracked the returns from stocks from 1951, and the most recent data is July this year. It's updated with a little lag. We can divide that data, or Ken French divides that data into 5 buckets, 3 buckets, 10 buckets, however you want to cut that data. He creates these so that we can look at, and in this instance we're using cash flow to price, which is like something like a cash flow yield. You can think about it like that. So and I'll go into these in some detail later, but just for the moment, Glamour is the lowest yielding cash flow group. So that might be the group that is the most expensive relative to its cash flow yield. And if you rebalance this on an annual basis since 1951, it's earned about 9.9% compound over that full period, which is a pretty reasonable return. But as you progress and you get a higher yield for your portfolio of cash flow stocks, the returns get increasingly better until you get to the value quintile, the value fifth, and the returns there far exceed anything else. And that's just buying companies that have the highest free cash flow yield. This is one of the interesting things I think about value investing, and it's one of the things that's most difficult to appreciate from the outside until you've sort of seen this occur on a number of occasions. We can create 2 different portfolios. These portfolios are created on price to book value, and we're calling the dotted line the undervalued portfolio, and we're calling the unbroken line the overvalued portfolio, measured on price to book value. And price to book value has lots of problems, I realize that, but it's useful to consider it here because we have one measure of value, which is the book value, and then we're looking at the performance of the earnings per share of these companies. And it's easy to see why the undervalued portfolio is undervalued, because the earnings have fallen to the point that we initiate the position. People think that the earnings are going to continue to fall. Why would you hold a melting ice cube, a value trap? And on the other hand, the overvalued portfolio has earnings that have gone up. So it's easy to see why you would want to pay more for that business, because it's obviously a much better business that's growing very quickly. And this is from a very famous bit of research by DeBont and Thaler. Thaler now has the Nobel Prize for Finance, 1987 paper called Investor Reaction, Overreaction. It's what happens next that's the really interesting thing. So this is about in the 3 years preceding the portfolio date, you can see the performance of the earnings per share of these different portfolios. But then once we form the portfolio, in a sort of counterintuitive way, it's in fact the undervalued portfolio that grows its earnings per share the fastest. And there might be a number of reasons for that. It may be that they're at the bottom of their business cycle, and at the trough when everything looked worse, that was the time to buy them, and the earnings started improving. And true also for the overvalued portfolio, it may have been closer to the top of its earnings cycle. It was more like that donkey reaching for the sun at the very top than the poor old fellow who'd fallen off the bottom of Fortuna's wheel. So we can dig into this a little bit further, and this is from another bit of research which we'll discuss in a moment. But basically, most value investors, I think if you spoke to most value investors and you asked them what they were trying to do, what they're trying to do is to find something that's growing very rapidly but is undervalued on the basis of that growth. And the reason they might do that is because if you plug those figures into a discounted cash flow analysis, it will show you that that company looks very undervalued. And so something that is growing very quickly but is cheap, we would designate as high growth value. If something is growing very quickly, but it is more expensive than that again, we designate that glamour. And there are lots of companies in the market that meet that definition today. Something that is growing very slowly, but is very undervalued, we call contrarian value. And then something that is growing very slowly, but is expensive, typically that makes a better short. That's why I've made it a skull and crossbones here. The paper is Lakonishik and Vishny's Contrarian Value. It's a very famous paper. It's one of the original papers in the behavioral finance. So there are two schools of thought. One is that value works because it is riskier. It buys riskier stocks. And then there's the other school of thought that says, no, it's a behavioral thing. People look at the performance of the underlying stocks. They extrapolate that performance too far into the future. And rather than anticipating mean reversion, what they are, they're described as naive extrapolation investors. They expect what has been going on to continue to go on, whether it be the stock price improving or the underlying earnings improving, when what tends to happen is there's more mean reversion in the market than folks anticipate. So just looking here, these are the same categories that I had on the preceding slide. I'm just trying to show you what the multiples and the growth rates are. So take, for example, the Glamour portfolio. The earnings growth rate had been growing at 18.7% per year in the 5 years preceding the formation of these portfolios on average. And folks were prepared to pay almost 20 times, 19.6 times for those earnings. So we could take a look again, look at the book value for the high growth value group. It's the middle column in the third row. You can see that the book value had been growing at about 13.9% a year, and they tended to pay about 0.3 times book value. So that would meet our definition of a value stock. It's at a discount to book value. These are pretty high rates of growth, so that's why it's high growth value. And then you might contrast that with contrarian value, which had been growing at a much lower rate, 2.5%. That might be even less than GDP, might be less than inflation. On a real basis, this company might be shrinking. And so it might make sense to pay even less for it. It's about 0.2 times book here, just showing really that this is a very undervalued stock, but perhaps for good reason because it's growing so slowly. So the question becomes, which of these portfolios do you want to invest in over time? Do you prefer the very high rates of growth at higher multiples, very high rates of growth at lower multiples, or low rates of growth at low multiples? So as you might expect, the value portfolio, the high growth value portfolio, does materially outperform the Glamour portfolio. So it does seem to make sense to pay lower multiples, even where you're getting comparable rates of growth. But here's the really unusual thing. The contrarian value, which was the lower growing portfolio available at an even cheaper price, tended to be the one that performed best. And part of the reason for that, as I mentioned earlier, is this mean reversion phenomenon where growth tends to slow down, and companies that are not growing particularly well tend to be closer to the bottom of their business cycle and tend to do a little bit better. So this is another study from 1994. We've just moved forward in time a little bit. It's a really fun story. So this Michelle Clayman was an analyst. She was aware of a book. It's now called, it's the greatest business book ever written, In Search of Excellence by Tom Peters. He identified this cohort of companies that they arbitrarily designated as excellent. And mostly it was because they had grown very, very rapidly. They were the very popular companies of the day when they put this together. And you can see why. When you look at the excellent column there in red, very high asset growth, very high equity growth, trading at a very expensive price, 2.5 times book. But maybe deservedly so, because they had excellent returns on capital, excellent returns on equity, excellent returns on sales. Contrast that then with the unexcellent companies. So this was Michelle Clayman's innovation. She said, let's not go in search of excellence, let's go in search of unexcellence. And so you can see when you contrast the unexcellent companies with the excellent ones, these are certainly worse companies. They were growing at a much slower rate, less than 6% asset growth on a yearly basis. Equity value growth, even slower. Available, though, at a big discount to book value, 0.62 times, but perhaps deservedly so, because they were earning so little on their assets, 4.88% on capital, 7% on equity, to a really measly 2.5% on sales. But this is the key. The excellent companies were 2.5 times book. The unexcellent companies were 0.62 times book. And I think that you'll guess that that's the determinative factor. So Barry Bannister, who was her analyst at the time, he's now head of research at Stifel. When I wrote Deep Value, I contacted him and I said, would you mind updating this research? Because I love that book. And I love that bit of research that you put out. And so he did. So that last bit of research that came out in 1994, this only goes to 2013 because the book came out in 2014. You can clearly see here, so the unexcellent portfolio is the broken line, massively outperformed both the market and the excellent portfolios. The excellent portfolios, in fact, underperformed the market. So overpaying for growth, for assets, for earnings, for cash flow is never really a good idea until you come to a period like the late 1990s, early 2000s. The market goes through these periodic paroxysms, and we're going through one now where the bubble, the boom takes off. And during bubbly periods, it doesn't help to be a value investor. It helps to be sort of a techier, more glamorous kind of company. And so we saw in the late 1990s that the unexcellent companies did in fact begin to trail the market for a very brief period of time. And the excellent portfolios caught up marginally. But then when we went back into a value type market, the unexcellent companies started performing again. And I think that it's easy to see the analogy to today and what might happen perhaps in the future. One of the questions that Barry Bannister addressed was, well, is there some reason why we might prefer these excellent companies? Do they do better when the world is going through one of these bad periods, or do they do better when the world is going through a good period? So the way that he examined that question was he looked at global economic growth from 1970 to 2012, and he just designated any period of growth below the average as a bad state of the world. Any period of growth above average was a good state of the world. And then he looked at which companies outperformed in which scenario. There's really no rhyme or reason to it. There's no method. Sometimes it's unexcellent companies outperforming. Most of the time it's unexcellent companies outperforming. Sometimes it's excellent companies outperforming. The excellent companies outperformed more in the sort of dot-com bubble and not really since, although that phenomenon has started again more recently. So one of the best books on value investing ever written is The Little Book That Beats the Market by Joel Greenblatt. It's a 2-hour read. It's a $15 book. It's a really great introduction to value investing. In it, Greenblatt talks about what Warren Buffett looks for when he buys companies. So Warren Buffett says that he likes to buy wonderful companies at fair prices. What does that mean? Well, wonderful company is a company that has a high return on invested capital, and a bargain price or a fair price is a high EBIT operating income on enterprise value. So a high return on invested capital, that's looking for companies that earn more per dollar for the dollar that's invested in them. So very good companies will earn lots of money sustainably. So commodity type companies will earn less money, and they'll do it cyclically, and I'll go through years where they lose lots of money. He's arguing that you should avoid those types of companies. And when we're determining whether they're overvalued or undervalued, we might look at a simple ratio of EBIT to enterprise value, which you can think of as like the inverse of the price earnings ratio, just including debt and other debt-like instruments in your price, which is the way that an acquirer would think about these businesses. And we use EBIT because it's unaffected by the capital structure, because it adds back in interest and tax, which interest is tax deductible, so it changes the nature of that figure when companies have different capital structures. All this does is it allows us to look through on an apples to apples, oranges to oranges basis. And I always say when I'm speaking to my amigos in Spain, Warren Buffett is, of course, Paramez. And I have Paramez's book around here somewhere. I'm a huge fan, and I love the book.
Absolutely.
So I have it right here. The test that we performed in quantitative value, which came out in 2012, was just to look at what is the driver of the returns to the magic formula. So what we did, we took Greenblatt's formulation as he described it, and we reconstructed it. We tested it on the gold standard for academic research, which is to weight the companies by market capitalization. In this instance, we're using equal weight, but we have done it with market capitalization weight. All of that does is it penalizes bigger companies, so that this is not a small company phenomenon. We also lagged the data, which means that we didn't allow the system to trade until June, and it was using the year-end data so that any revisions were well and truly disclosed to the market. The system didn't trade ahead of that. And then it uses a point-in-time database. So if a company is in the database and it goes bankrupt and it fails, our system can buy it, and it can go bankrupt and fail in the period that we're holding it. So as you can see, Greenblatt's formulation, the magic formula, does materially outperform the S&P 500. But the really interesting thing is what drives those returns. So we can look at return on invested capital only, and we can see that that doesn't do quite as well as the magic formula does. And when we look at what drives those returns, we find out that it is in fact the value multiple, and that's what I call the acquirer's multiple. That's where all of the returns accrue. So this is just another way of looking at it. We start on the left-hand side with return on invested capital only, and then we just sample different mixes. Let's not make it return on invested capital only. Let's say mostly return on invested capital, 90% return on invested capital, just 10% value weighting. So now we're really looking for high-quality companies, but maybe we think about them a little bit in terms of valuation. We keep on doing that until we get to the 50-50, which is the magic formula, because that's the way Greenblatt weights them. 50% quality, 50% value, and then we proceed on to the right with the acquirer's multiple. And as you can see, that every time we add a little bit more value into the mix, we get slightly better performance. And I think that that's a pretty compelling slide. Just to show you what that means over the full set, this is every single one of those mixes. The very green one is acquirer's multiple on the top. The very red one on the bottom is pure return on invested capital. Over the full data set, this is a log scale, and I'll show you what that means in a moment. But basically, there's quite material outperformance consistently for the value strategy over the magic formula and pure quality. There are notable periods, however, where that's not the case. So 1982 was a notable bull market where return on invested capital did much better. Famously, the dot-com boom in the late 1990s. And again, today we're seeing some of that. The higher quality companies are doing quite well. The value companies are being quite compressed. So this is just the same chart, just with the log axis taken out, and you can see that the outperformance is quite material. We call this sort of a liar axis because it makes the good stuff appear much better than it might otherwise be. So the log is the one that you should pay attention to, but this is just to demonstrate what it really means to compound at those higher rates over the full set. It's quite a lot of outperformance. It's not just raw performance; it's also better risk adjusted. You can see the return is higher. Clearly, you get slightly more volatility, slightly more variation in the performance when you're buying these cheaper companies. But for the amount of gain that you get, for the amount of return that you get, you're compensated for that volatility. And that's why you end up with these better Sharpe ratios, better Sortino ratios. You can live a long and happy life not knowing what those things are, but I like to put them in just so that folks don't think that it's just a matter of raw performance. This is something that it works overseas. I've pulled out Mexico here, but I have Spain in here as well. Spain is to the on the top column, fourth from the right. Spain has the enterprise multiple in this instance, which is a close cousin to the acquirer's multiple, brother to the acquirer's multiple, has generated around 80 basis points of outperformance just using those value strategies. So it's a very successful strategy. The reason is, of course, mean reversion. So this is a research by Michael Mauboussin, who's a great writer, commentator, researcher in the States. He divides these, he looks at the top 1,000 companies and he puts them into 5 buckets, so quintiles, and he divides those buckets by return on invested capital, which is the same metric Greenblatt used, Buffett uses. And what he shows is that this is mean reversion in practice. So the companies that have the very highest return on invested capital tend to drift back towards the average. The companies with the very worst tend to improve. And if you hold these companies, that improvement will manifest as slightly better returns, slightly better growth, slightly better earnings. And that undervaluation that might have been meaningful because they had that very low return on invested capital, or overvaluation because they had the very high return on invested capital, slowly leaks away over time. And that's why these companies tend to outperform. Jeremy Grantham of GMO says that these profit margins might be the most mean reverting series in finance. And it's for the simple reason that if any company starts making very material profits, its competitors will come in and seek to get some of that profitability for themselves. A good example might be Tesla, for not a great deal of investment, trades at a very high multiple in the market. And then a company like Nikola comes along and basically takes the same playbook, tries to implement it, not as successfully, but still at its peak had a $30 billion valuation, not much more than a PowerPoint presentation and a prototype that didn't work. So this is to update the research to date. So we can take, here we have the Glamour portfolio in red and the value portfolio in green. So this is going back to the French data, which I showed you at the start, which is available for free online. You can go and download this and test this as much as you want. These are the deciles. So this is divided into 10. And here we've just taken the value decile, which has the highest cash flow yield. And we compare it here to the Glamour decile in red, which has the lowest free cash flow yield. And we can see that if we form these portfolios on an annual basis, over the full data set, you get very material outperformance for the value portfolios, and the total magnitude is almost double. So the value portfolios have returned twice as much as the Glamour portfolios. Question is often, why would anybody buy the Glamour portfolio? It's for the obvious reason that they're the sexier companies. They're the companies that are going up in the market right now. It's the stuff that everybody wants to own. And the value strategy does periodically underperform. And I'm going to show you now. So in order to show you the relationship between these two, I'm going to take the green line performance and divide it by the red line. So you'll be able to see when the chart is going up, that's the green line outperforming the red line. When the chart is going down, that's the red line outperforming the green line. So the black line here is the red line and the green line from the preceding slide divided by each other. So for the full data set, there's massive outperformance to value. You can see through to about 2014, or there's a little peak around 2009. There's this sort of two horns sticking up right at the very top of the black line. The value portfolio had returned since July 1951 through to around 2010, 2014, had returned more than 500 times what the red line had done. And that's the magnitude that you achieve by having an 18.1% compound return versus a 9.1 compound return. Since 2010, the red line has outperformed the green line such that you can now turn your attention to the orange line. It's drawn down against it by about 56%. And at the very bottom, it was about 62%. So what that means is that since about 2010, Glamour has gone up around 5 times against value, and value has fallen away. So it's not the first time that this has happened. It's certainly the biggest one that we have in this data. So if you look at, there are lots of little, in around 1959, the market drew down, value underperformed by about 24% before it bounced again. Similarly, in the late 1990s, you can see there's another peak that just goes down below that 20% line. It's about 24% as well. That was the dot-com boom. And at various other times, there have been these little periods of underperformance. There was another one, there was one in 1980s, and there was another one in the dot-com boom. And then since 2010, it's been a very rough run for value. It's been a market that has preferred these lower cash flow yielding stocks, much more glamorous tech stocks that are growing much more rapidly versus value stocks, which have a higher yield and perhaps lower performance. It's not the first time that this has happened. So this is a chart from a friend of mine, Mikhail Samanov. He runs a company called 2 Centuries. This is the value factor. So that's price to book value. In the preceding slide, it was price to cash flow. It doesn't really matter. You get roughly comparable charts, whatever you implement. It's just that we happen to have this data. So he's stitched together 3 data sets. The first in the blue on the right-hand side is somewhat comparable to it's the same data set. It's the French data set for price to book value. So I showed you the French data set for price to cash flow. This is the price to book value. And you can see that runs from about early 1920s. And there's a big drawdown in, that's the 1932 mark there, 54% down. This is against the Glamour portfolio. That was around the Great Crash. And then you can see that's Benjamin Graham's portfolio. Graham Newman ran from 1936 to 1956. Buffett started about 1956, and he's run to the present day. So this is the worst drawdown that Buffett's ever seen. And you'll see from his performance that this is the worst underperformance that he's ever had too. The orange line is the Cowles Commission. So that was famously, Cowles produced these punch cards. Graham referred to it as well, said that value had outperformed in the order of about 15% a year. And that data runs from the late 1800s to the early 1920s. And then before then, they were able to go back and by hand, they found these reports. And so the way they assessed value here was was dividend yield. So it's an incomplete data, but it's still interesting because it does give us an idea. You can see from 1841, 50% underperformance, 1862, 49% underperformance, 1904, 59% underperformance, which is comparable to the one that we see today, there have been multiple periods of massive underperformance. So it's not that value's broken, it's just that the value factor does underperform materially for extended periods of time on a regular basis. And it's something like that phenomenon that keeps it evergreen, that keeps it working, because folks just don't trust it. They'd rather be in the more glamorous stocks. Going back now to the cash flow yields, this is the French data again. Just to describe what's going on in this chart, the orange columns, that is the cash flow yield of the value portfolio in every given year. So that you can see on the left-hand side. So in its very best year, that cash flow yield for that value portfolio is more than 40%. On average, over the full set, the value portfolios have averaged about 24.1% cash flow yield. So for every dollar of value stocks that you buy, you're getting about a 24%. You could think of it like an interest rate or a yield. By contrast, the blue line, which is the blue columns on the very bottom, that's the Glamour yield, also on the left-hand side. It's averaged about 3.9% over the full data set, running back to 1951. It's currently yielding 1.7%. So it's less than half what it has been in the past. And typically what that has meant is lower returns for Glamour in the future. The black line, well, the orange, just going back to the orange columns, the cash flow yield for the value portfolios is about 26.6%. So that's slightly richer than it normally is, which might indicate that slightly better performance for value is in the future. And the black line here, that's just taking the value yield and dividing it by the Glamour yield. And you can see that the difference between the two portfolios now is approaching the late 1990s, which in this data set is the best outperformance that we had, and at the time that it occurred, the worst underperformance to that point. At 15.6 times, you're getting 15.6 times more cash flow yield by buying the value portfolio than the Glamour portfolio. Typically, what that has meant in the future is better returns. We don't know necessarily that's what's going to happen now, but that would be my bet that we're likely to see much better performance. What is largely driving it, though, it is clear, is that Glamour is extremely expensive. Glamour is unusually expensive right now. There aren't very many instances in this data set where Glamour has been this expensive, and value is slightly rich. So I think that probably what that means is that Glamour is going to have a very rough run over the next period of time, and value might do slightly better than average. So perhaps the best way to play this is in some sort of long-short portfolio. So I'm happy to take any questions. Ivan, let me know how you'd like me to proceed.
I have a bunch of them. Because, I see, Toby, that, okay, this is super interesting. This presentation is super clear. And actually, that my bias also is totally, I'm a value guy, totally value guy. And, but I have in my mind this thing that, okay, we study the past, we understand what's happening. And then I see also at a time that the world is changing at a very, very, very rapid scale, and technology is getting into the stuff. So we're seeing now that this, technology is escalating a lot, and I wonder if there's something, maybe, I don't know, but might be something that we are forgetting regarding how to study value, okay? Because we use the past and we understand the past. So the cheap stocks, always they have worked, even these big periods, okay, of underperforming. But given this situation with this technology, the escalation of technology, AI, do you think that maybe we are forgetting we should put something into the formula to understand that maybe value can be studied as it's been over the past? What's your take on that?
I think if you look back at the periods of time when value has underperformed, even going back to the chart from 2 centuries, which begins in 1825, I've spent some time going through that chart for my own purposes and just annotating what was happening at the time. So 1825 was, and this is American data that we have, 1825 was the beginning of the Industrial Revolution in the US. And it's one of those periods of time where value didn't do very well. That was where Commodore Vanderbilt had the first steamship fleet, and steamships were the technology of the day. And then shortly after steamships, there came railroads, which were the technology of the day. And you can see any one of these, I can go back to the chart. You can see these, this one. So 1841 was around the invention of the telegraph. Before the invention of the telegraph, information traveled as fast as men did. So if something happened in Europe, the information didn't get to the US until a sailboat made it across the water.
Absolutely.
So it took weeks and weeks. And pretty soon after the invention of the telegraph, they laid a subsea telegraph from the east coast of the US to the west coast of Europe. And information was almost instantaneous. So you can imagine at the time what an enormous leap forward in technology that was. Same with the train. People thought that if they rode faster than a horse could travel, they'd be atomized, they'd be turned to dust. So all of these things were massive advantages. You could take goods and people across the countryside rapidly, where you could never do those things before. And the technology was so exciting that people, like they do today, they had all of these new listings, lots of IPOs, the stocks all did very well. Ultimately, though, these things have to perform as businesses. They aren't only judged on their technological promise. The promise has to result in earnings, cash flow. And that's where value investors excel. They look at these quantitative metrics. And so all of these booms, I think, have had good technological reasons for them. And at the time, it was very exciting and people didn't want to be invested in the things that weren't performing. But over time, Graham describes this as moving from a voting machine to a weighing machine. Over time, these companies are weighed on the amount of money that they can generate, because that's the function of a business. And when that happens, value comes back again. We're just going through one of those periods now. The promise of the internet, the promise of software as a service, these new business models that are recurring revenue, they are all very exciting and they do seem to promise great things in the future. At the moment, some of them are delivering on those things. Many of them, the promise remains in the future and may always remain in the future. I think that this is one of those rare occasions where value investors really do have an unusually great opportunity set, and at some stage value will likely massively outperform. And I think that we'll have a hangover from the tech stocks, much the same way we had the hangover in the late 1990s through the early 2000s.
Yeah, actually, I was trying to put you in this situation because ultimately value makes sense. And, this idea of buying cheap companies, even we have this technological revolution is, as you mentioned, is something totally normal that has happened previously. But in this situation, this mania, pushes people towards these new ideas. But I think it's all the same. So it's nothing has changed, actually.
It's a very long period of time. I mean, you can see that if the outperformance of growth over value, with the chart that I have up at the moment, you can see that there are these extraordinarily long periods of time where growth outperforms value. And if you look at so I can go back to this, even this chart, which shows.
There goes my next question. You'll see. Go ahead.
Basically, I've done this on a daily basis or on a monthly basis. And so it's hard to believe this, but the red line outperforms the green line on 80% of months. It's just that the green line, when it does better, does so much better that it's worthwhile. It generates 2 times the return. And if you see on this chart, this is just that last chart divided by each other. It can be a little bit confusing, but it's intuitive to me. It shows how much more money you get by being invested in the green line over the red line. When it's going up, the green line's outperforming. It's hard to believe that the red line actually outperforms 80% of the time, but the green line, when it does work, it works so much better that you want to be in the green line. And then you get these periods of time like we're seeing now where it underperforms. And it's easy to look at a line on that chart and you forget the agony of being in that value portfolios that's underperformed since about 2014. It's an extraordinary long time. That's when my book Deep Value came out, and I've written 2 other books since then. It's been a rough run for value.
Absolutely. Actually, my next question was about that, because okay, so how do you manage, Toby, this pain? Because value, what I see is that this 80-20 rule that works here also, and so it makes sense. But then if you decide to build a portfolio, a value portfolio, or in your case, a fund, so as a value manager, how do you control the pain? Because pain, there's a lot here to take. So how do you manage that?
Well, there are 2 questions. That as an individual value investor, I think it can be a little bit easier because nobody's necessarily looking over your shoulder and seeing what you're doing. I think that you have to get comfortable with the companies that you own. When I look at the portfolio of companies that I own, I'm very happy to hold those companies because I can see that while the revenue line, I know for my portfolio companies, the revenue line grows about 6% a year on average, but the bottom line, the profit line, grows about 11% a year on average. And the reason why it's almost double is these companies buy back a lot of stock and they're getting efficiencies out of their businesses. If you look at the growth companies, it's actually the reverse. They grow the top line very rapidly. But when you include things like share-based compensation, which is a real cost, it's just that it's not necessarily run through the income statement. They're actually, on a per share basis, they grow much slower than my own companies do. It's just that this is a market that rewards revenue growth and doesn't really care about much else. It's happened in the past. It'll happen again in the future. From my perspective, I just look at the opportunity set and I look at my objective as a value investor is to buy the best opportunities that I possibly can. And so for my definition of what a great opportunity looks like, I like a cash-rich balance sheet because that means that the normal vicissitudes of business where bad things happen, good things happen, they can ride those out. I like them to generate lots of free cash flow. And then I like to make sure that management is a management that is going to help you as an investor make money. And the way that they do that, they don't pay themselves lots of money. They don't go and try and buy other businesses, although that's okay too. If they're good purchases, that's good. But what they do is they tend to buy back stock. They pay down debt. All of these things are very simple. And that's a good test of whether a manager knows what he or she is doing. If they take their undervalued stock, they take their free cash flow, they buy back stock, because that just keeps on concentrating the value for the remaining shareholders. In the past, companies have responded very quickly to those sort of moves. More recently, that's not been the case. But as a matter of logic, as a matter of practice, it makes sense to me that that's the kind of company that I want to own, because I don't measure my own performance on what the stock price does necessarily. I'm looking at what the value of the underlying holding that I have. So my share of that value, what is that doing? If that's growing at a rapid pace over time, I know that eventually the market will wake up and it'll be rewarded in the stock price.
Yeah, absolutely. Okay, so I have the last question is if you can give us a glimpse about your short portfolio. What do you manage this long short strategy? Because this is not a common value fund. This is a long short fund. Yeah. By the way, I'm invested in. So
I'm happy to hear that. So sure. The reason for shorting, there are periods of time. So in March, we saw that the market fell very rapidly. It fell more rapidly in March than it did in 1929, which is sort of it didn't fall as far. The market fell about 34%. Value portfolios fell about 50% through that period of time. The shorts in my portfolio, even though they're only about a 30% weight in the portfolio, all of those companies that I was short went down much more than the market. And so the portfolio fell about as much as the market did, which might not sound like great performance, except that other value funds were down about 50% through that period. So we got about 15% outperformance for value. My expectation for this crash was that something like that would happen, because this is what we've seen before. In 2007, 2009, there were two big crashes. It's hard to remember that because it all felt like one, but there was the crash from 2000. There was a crash that started the top was actually June 2007, and there was a sell-off. There was a very big rally, and then in late October 2008, there was a second big crash. And so that's not uncommon, and there seem to be some technical reasons. There are market makers and option strategies that shorts, people trying to rebalance. It seems to be technical reasons why this happens. And so in 2007, energy had been very strong going into that crash, and it was unaffected through the first part of the crash. Energy sort of seemed to skate over the devastation that was hitting everything else underneath. In the second part of the crash, energy caught down to the market. And I think that we're starting to see a little bit of that now, but replace energy with tech. Tech sort of avoided a lot of the first part of the crash, skated over the top of it, and then has rallied very strongly, probably much more strongly than anybody would have anticipated. And now, value stocks, when the market has been weak, value's been off about 20%. The FANG names have been off about 20%. They're having a little rally now, but again, we're seeing weakness in names like Tesla. And I think that Tesla's emblematic of what's going on in this market. At its heart, Tesla is just a metal bender. For them to grow, they've got to build more factories, and that's an expensive, capital-intensive process. But they're treated as if they're this hyper-growth stock, and they've had no growth over the last 3 years. So I think that as Tesla goes, so goes the market, and the weakness in Tesla, I think, will manifest as weakness for the rest of the market. When that happens, the companies that I hold in the short book, I would hope that they will be down considerably more than the market, because the sort of things that I like to hold in the short book, they're extremely overvalued to the extent that you can determine a value for these things at all. They're highly leveraged. They carry lots and lots of debt. They're negative free cash flow. They issue stock to stay alive, or they raise debt, which is something that Tesla does too. What that means is that they're relying on the capital markets for support. So when the markets are going up, there's no problem for them. When the markets turn down, that creates a catalyst where they have to get money in the very near future. And that's why they tend to sell off so sharply. On top of all of that, it's not enough to identify those sort of stocks and to short them, because when the market is frothy, these kind of companies keep on going up. So the other thing that I do is I look for broken momentum. So broken momentum is just a stock that's not going up anymore. Basically, it's already started to fall. This is very common for guys who short. This is less common for value guys to discuss price action, because it feels like there's something wrong with it when you're doing it. But I've just learned over a long period of shorting that you don't want to short things that are going up or growing very rapidly, because something that's, if it's on a 30 times multiple or a 50 times multiple, but the underlying earnings are growing at 30% a year, the market doesn't care that it's on such a high multiple. It'll still be, it'll go up 30% and it'll be on a 50 times multiple again. So that's not a good company to be short. You want to short things that are fundamentally broken, that have statistical indications of fraud, statistical indications of earnings manipulation, financial distress, issuing lots of stock, all of the things that are basically the reverse of what I want in my long portfolio. And I think that the rebalancing between the long portfolio and the short portfolio over time, it has this effect. It's known as Shannon's demon, where basically you take away, Claude Shannon, who's the father of information theory, invented the bit, which all modern computers are based on. He had this observation that if you could create this creature that could take from a portfolio that is working and contribute to a portfolio that's not working, provided that the portfolios are totally moving against each other. So when one is up and one is down, and then the reverse like this, you can actually have two portfolios that go down over time, or two assets that go down over time, but the portfolio will go up. And so I'm trying to create that effect in my long short portfolio by rebalancing away from one side and adding to the other. Over time, I think that will generate performance beyond what either of the two portfolios do. I think that in the event that the market goes down, it should outperform pretty materially. And over time, not going down as much as the market and capturing some of that Shannon's demon effect, in addition to the value portfolio, should generate very good returns. That's my hope. That all of that is, of course, in the future, and I don't know what's going to happen, but that's the intention for the portfolio. Instead
of technological promise is Toby promise.
That's right. That's not a guarantee, but that's what I think is going to happen.
Sure. No, it makes all the sense. Actually, listening to you is like, and you explain things in a very, very interesting way, and it's you bring sense, and it's something that we need now in this environment we are living, with this COVID thing, the pandemic, the situation that is everything seems to be broken, and now, and as investors also, we have this value underperformance. Many of us have invested a lot of money in value strategies, and it's something that now is the moment to listen. I mean, guys like you. So thank you. And I have a funny thing also to say, that from this perspective, your mic looks like the Tesla logo. so it's like I see there this shape, it's like the Tesla logo from this perspective. It's super funny.
Well, I'm a big fan of Musk's, and I'll do like the cars, but I just the stock is too overvalued at the moment.
Absolutely. Okay, Toby, so it's been really, really, really a pleasure to have you on here, closing the event. And last year we had a very, very great time with you. We translated your books, that is for all of you guys, if you want to read it, you have it in Spanish and in English, of course, his book.
I have it here.
Exactly, Deep Value. This one is in Spanish and in English also. So I don't know, it's really, really motivated. Okay, I hope we can do these things much more time, Toby. Thank you.
I hope so. I always love talking to ZONAVALVE and to you, Ivan. It's an absolute pleasure. It's great to see you again, my friend.
Okay, thank you. Likewise. Bye-bye, Toby.
Ciao.
See you soon. Bye-bye. Ciao.